There's a trader who turned his starting capital into 113 times its original value in just 1 year at the most prestigious trading competition in history, the Robbins World Cup of Futures Trading. To this day, no one has come close to breaking his record. That trader is Larry Williams. But here's what makes the story even more remarkable. His teenage daughter, who he trained personally, went on to win the same competition with a tense return. Father and daughter, both champions at the world's most competitive trading event. So what was the strategy at the center of it all? Today, we're going to break down the Donchian Channel, the core tool Larry Williams used in live trading. If you think breakout trading is just buy when price breaks the high, you need to watch this video to the end. Most traders are only using half of what the Donchian Channel can do. Here are the 3 strategies we'll cover today. The Donchian Channel Midline Entry strategy, the LWTI Trend Filter strategy, and a multi-confirmation strategy that combines all 3 conditions for maximum precision. Before we get into the strategies, let's talk about where most traders are losing money. The Donchian Channel is a widely used indicator for breakout trading. The basic idea is straightforward. Buy when price breaks above the upper band, sell when it breaks below the lower band. It's simple and intuitive, which is exactly why so many traders use it. But that same simplicity is what leads to the same mistakes over and over again. Mistake number 1. Buying every time price breaks above the upper band, no questions asked. It feels right. Price broke the high. It should keep going up, right? The problem is, in a ranging market, this signal fires constantly. Price pushes up, then comes back down, then up again, then back down. Without a trend behind it, you're just chasing signals and getting stopped out repeatedly. Mistake number 2. Using the midline purely as a stop loss and nothing else. The midline is a stop loss reference, but it's also a trend filter that tells you whether price is in the upper zone or the lower zone of the channel. If you don't know this, you can end up entering in the wrong direction entirely. Mistake number 3. Entering on price signals alone without checking volume. Even if it looks like a breakout, if volume isn't behind it, it's not a real breakout. That's a fake out, a false signal designed to trap you. Keep these 3 mistakes in mind as we go through the strategies. You'll naturally start to see why each strategy is built the way it is. The basics. The Donchian Channel was created in the 1950s by trader Richard Donchian. The structure is simple. The highest price over a set period forms the upper band. The lowest price forms the lower band. The midpoint between them is the midline. For example, with a period of 20, the channel plots the range between the highest and lowest price across the last 20 candles. A wide channel means the market is volatile. A narrow channel means the market is quiet. There's a reason the Donchian Channel works particularly well in crypto markets. Crypto is far more volatile than stocks or forex, and once a trend gets going, it tends to run hard and hold. The Donchian Channel is built to catch exactly those kinds of trend moves right at the start. A few notes on settings. The default period is 20. For timeframes, we recommend the 5-minute chart for short-term trading and the 1-hour chart or above for trend confirmation. Strategy 1. Donchian Channel Midline Entry. The first strategy is the most straightforward way to use the Donchian Channel. The core idea is simple. When price breaks above the upper band, it's a signal that strong buying pressure has entered the market. But jumping in right at the breakout means you're buying the high. Instead, this strategy waits for price to pull back toward the midline after confirming the breakout, and enters there. Confirm the trend with the upper band breakout. Enter at the midline. Here are the long entry conditions. First, confirm that price has broken above the Donchian Channel upper band. Then wait for price to pull back to the midline area, and enter long there. Stop loss is set at the lower band. Take profit target is set at twice the stop loss distance, a 2-1 risk-reward ratio. For short entries, the logic is reversed. Confirm a break below the lower band, then enter short on the pullback to the midline. Stop loss and take profit follow the same structure as the long side. Strategy 2. LWTI Trend Filter. The biggest weakness of the first strategy is ranging markets. When price is moving sideways, channel signals fire frequently, but there's no trend to follow, leading to repeated stopouts. To fix this, we add the LWTI indicator in TradingView. LWTI is a community indicator. You can find it by searching LWTI. In the indicator search bar, LWTI stands for Larry Williams Large Trade Index. It shows whether large institutional money, the smart money, is positioned on the buy side or the sell side. Set the LWTI period to 25. Reading it is simple. When the line is green, the trend is up. When it's red, the trend is down. One rule: when LWTI is green, only take longs. When it's red, only take shorts. Long entry conditions. When price breaks above the Donchian Channel upper band and LWTI is green, enter long. Stop loss is at the Donchian Channel midline. Take profit target is at least twice the stop loss distance. For short entries, the logic is reversed. When price breaks below the lower band and LWTI is red, enter short. Stop loss and take profit follow the same structure as the long side. Strategy 3. Multi-confirmation setup. The final strategy only enters when every condition from the previous two strategies is met at the same time. We add one more condition on top: volume. Volume must be above its moving average for the signal to be considered valid. That means 3 conditions must align before entering: Donchian Channel Breakout, LWTI Trend Direction Match, and volume above the moving average, all 3 at once. Long entry conditions. Price breaks above the Donchian Channel upper band, LWTI is green, and volume is above its moving average. All 3 must be true at the same time. Enter long. Stop loss is at the Donchian Channel midline. Take profit is set at a minimum 2:1 risk-reward ratio. If the trend continues strongly, you can trail your stop by following the rising midline. For short entries, the logic is reversed. Lower band breakout, LWTI red, volume above its moving average, all 3 confirmed, enter short. Stop loss and take profit follow the same structure as the long side. The whole point of this strategy is fewer entries, higher probability. These 3 conditions don't all line up very often, but when they do, stop-outs are less frequent and you're more focused in the high probability zones. Let's quickly recap the 3 strategies from today. The first was the Donchian Channel midline entry strategy. Confirm the breakout at the upper band, then enter on the pullback to the midline. The second added the LWTI Trend Filter to reduce stop-outs in ranging conditions. The third combined all 3: channel breakout, trend direction, and volume to maximize accuracy. If you want more chart analysis and trading insights, join our free Telegram channel. The link is in the description. If this video was helpful, please like and subscribe. Your support is what makes it possible to keep creating content like this.